What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is August 3rd of 2020. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, we not only have to focus on the historic event that last month alone we printed more money in the United States than we have in the entire past 2 centuries of our history. And along with that as well, during this time period, we've seen gold, silver, Bitcoin, cryptocurrencies as a whole breaking out in record pace volume into decentralized finance. So we're going to be talking about all of this and more and why it's important right after our quick sponsor. Our sponsor for today's episode is Bitpanda Pro. Bitpanda Pro is the secure European exchange for crypto to fiat markets. Bitpanda has been offering secure, straightforward, and easy access to the cryptocurrency market in Europe for over 5 years and wants to offer the same service to more experienced traders, users using trading bots, and other advanced clients like cryptocurrency businesses and institutional investors. With the steady addition of more and more crypto to fiat trading pairs, Bitpanda Pro has made itself a convenient, secure, and trustworthy exchange to onboard or cash out easily. Check out the link down below in the description to learn more. Alrighty, everyone, so let's go ahead and just dive straight into it. For cryptocurrency markets, we're seeing again the kick up here for DeFi, Terra, Ren, Ocean Protocol, Aave, Loopring, Synthetics Network, Kava, Thorchain, all these major plays, Bancor, Band Protocol, Chainlink, iExec RLC, and Tezos. A lot of major DeFi and enterprise blockchain plays kicking off and doing well here. Again, taking a broad look at the cycle here, Bitcoin has had a phenomenal month. We went up over nearly 25% within a single month. The actual figure here being around 24.26%. After a consistent set of months of recovery here since the flash crash back in March of 2020. And the great thing is here is that we're coming towards the midpoint here for our estimated length of the cycle. So we're almost exactly where we should be here. In fact, we're probably a little bit ahead of schedule considering the length of this cycle. And you're going to start to see, I think, over time, more and more of the cycle is starting to kind of hold towards this level here ahead of time because you're working with a logarithmic chart. And we're really going to be starting to head up towards much higher levels. Going here towards altcoin dominance. Looking great. I mean, guys, again, we have consecutively been long on altcoins since back here in September. Many people said, I had many people out there in the cryptocurrency space say, oh, this is going to be a terrible call. Nick's going to regret it. And quite frankly, it's worked out great. And the reason why is because we were focusing here and taking a look at historic levels, but also after a very stark secondary decline from what we saw back here from May down here to September of 2018, we saw a repeat here, right? Going in from March right here in 2019 down to September of 2019. And we started to set higher lows. And the more we set of these higher lows and higher highs on the altcoin dominance chart, or if you want to look at it in the sense Bitcoin dominance, and the vice versa nature where we were setting lower highs and lower lows. In this case, it's a sign of confidence for altcoins. And we've been rewarded greatly by playing a lot of the DeFi plays, a lot of the calls that we've been talking about in the Dash report as well. Now, I want to go ahead here and talk a little bit about the macro environment here. I think a lot of people really start to ask a lot of questions here when it comes to central bank monetary policy. And really just to kind of get a perspective of what we're living through right now. Right now, the United States in the past month was printing more money. So the Federal Reserve printed more new cash than it has in the last 2 centuries. So, again, a lot of people have some questions here. Is this going to lead towards mass inflation? Is this going to, for example, kill the dollar? I think there's a lot of questions that come up here. And it's very, very difficult to provide a clear answer here because, in this sense, we can obviously see the Fed is printing money, but printing liquidity, right, printing currency doesn't actually always lead to inflation. This is something that's important to keep in mind here because unless it gets into the hands of consumers at excessive levels, right? In this case, you're not going to really get inflation in the economy. You're not going to actually get money circulating in the system. So what's really going on here when the Fed is printing money in this case, right? Are we seeing inflation to a degree? Yes, we are seeing inflation to a degree, but probably not in the areas you would think. There's one thing that I think is really valuable here, and this is an index called the Chaplin Index. So a lot of people in traditional finance and major economists as well, they make a very big mistake, and that's that they look at the CPI, the Consumer Price Index, which is utilized and generated by the federal government and utilized by the Federal Reserve and other major institutions across the world to basically designate the general rate of inflation in the economy. And as much as that can be, it has such a sense of authority because it's coming from the federal government, right? Obviously treasuries, coming from the federal government, one of the most respected assets in the world. We can just kind of take it at face value. But in reality, the CPI has a lot of issues. Predominantly, the federal government's incentive to constantly keep changing the CPI. In fact, there's a really good summarization down here that they mention where they showcase that there's a large figure here in this case, that it's estimated between 1996 to 2006, the reconfiguration of the CPI saved the government over $680 billion. And this is due to a variety of probably different programs that the government offers considering an inflation. So keeping inflation artificially low actually comes in the benefit of the government here. But along with that as well, right? The thing about the CPI is that the Federal Reserve wants to constantly encourage and state that inflation is not high enough and that they need to continue monetary practices in order to boost that inflation. Well, what's the catch here? What's the problem? Obviously, the cost of living generally has been going up, but where has it been going up? It's been going up in an area of the economy that is directly affected by the increase in investments, the increase of capital allocation to assets, and that is not only obviously stocks and other assets that really don't serve as a part of our everyday living expenditure, but properties and cost of living. The Chaplin Index does a phenomenal job of really capturing the real rate of everyday expenditures and increased growth for people who are living in the United States. And I bet you could use a similar metric if we had the data points for other countries. But just as a kind of a capture of what's going on here, these are some of the major cities here: New York, Los Angeles, Chicago, Houston, Philadelphia, Phoenix, San Antonio, San Diego, Dallas, San Jose. All of these somewhere in an inflation range, generally speaking, most years between the upper 7% range all the way up to 12 to 12.3%. Massive rates of inflation here across the board. All right, if we even just take the lower ballpark figure here, 7%, right, is much different than what the Fed is stating through the CPI, which usually ranges a little bit below 2%. And the Fed's target is supposedly 2% here. So where is the majority of that coming in? Well, the Chaplin Index factors in a lot of different products that the CPI doesn't, that are everyday products, but also a lot of things such as rent and housing. Right? A lot of the things that maybe might not get factored in as much as they are in the CPI. So this gives us a much fairer image here. And what this proves is that with all this central bank liquidity, we're really seeing it flow into financial markets. We're seeing it flow into financial transactions. They're going into activities that tend to stimulate assets, like properties and stocks. And that's basically led to the dichotomy we've been in, where asset prices have skyrocketed while general GDP in the US in Q2 went down over 30%. Stock market rallies, economy breaks down. Where's the divergence coming in? It's because of central bank liquidity and artificially low interest rates. Artificially low interest rates really don't stimulate the core economy. We've seen this in Europe. If it worked, then we would be seeing it by now. But what we've been seeing is an issue where liquidity is only flowing into financial activities. So on the quantitative easing side, it's really not QE, it's not capital injection into loan programs and industrial manufacturing and real GDP activities. But in reality, it's really just boosting financial markets. Now, I want to go ahead here and talk about a fundamental shift that we're seeing. We've not only seen cryptocurrencies and gold and silver and precious metals abroad and commodities in general doing very well in this environment with central bank liquidity the way that it is, but we are seeing a record pace of adoption for a lot of blockchain applications. Decentralized exchange volumes rose 174% in July, topping $4.3 billion and setting a second straight record here. Now, again, we really started to hit our parabolic moment here. And this isn't just for decentralized exchanges. It's not just one, too. It's Uniswap, it's Curve, it's, for example, plays like Kuiper Network, it's Bancor. It's a lot of other different plays here that are doing well across the board. I know Balancer as well, another one of the key plays. But along with that, we're seeing a record amount of Bitcoin moving on to the Ethereum blockchain. Now, I gotta say here, guys, it really seems here, there's no argument at this point that the layer 2 for Bitcoin right now is looking to be Ethereum. And again, I think that, this is completely fine because I want to see Bitcoin play a role in DeFi. But it showcases how the market is going to find a way here. There is a need right now for people to not only be able to get access to Bitcoin, people want that exposure to a non-correlated asset, but they want to be able to do things with it. They want to earn interest on it. They want to be able to utilize it in financial transactions. They want to trade against other ERC20 tokens in a decentralized fashion. It is here, right now. It's not a year or two out, right? The trend is starting here. If you want to wait until it's mainstream, yeah, maybe it's going to be about 2 or 3 years. But folks, it's getting here. And this is really, really exciting to see this kind of shift of liquidity going from around, hovering around 5 million all the way up nearly to 20x of that within the course of just a few months, 3 months later. This is really exciting times, guys. And again, I could ramble on for hours here, but we are in the next cycle here. I know a lot of people define the next cycle as getting above the previous highs, and fine, if that's how you'd like to label it, that's completely fine, but we're getting there very, very soon. If we're on the normal trajectory of where we are now, we're going to be getting there by the end of this year or in Q1 of 2021. It'll be here before we know it. And I'm very, very excited to be here on this journey with you all. So if you want to learn more about the Chapwood Index, you can go over to chapwoodindex.com. This is just something that I always love to turn to when I take a look at the macro environment. You can find all these articles on Cointelegraph, and also as well, you can always head over to CoinMarketCap here to check out what's going on in the market. But that's all. That all being said, everyone, I hope you all are having a fantastic day wherever you are. If you can, drop a like, consider subscribing, consider hitting the bell icon as well. Leave a comment as to what you think about what's going on here. And if you haven't already, please consider checking out Digifox if you're interested in getting exposure to some of the DeFi tokens out there, as well as the enterprise blockchain tokens in the market. We have access to those through the application. But outside of that as well, if you want to support the channel, consider subscribing to the Dash Report, where we not only cover crypto markets, but traditional equities, commodities, and Forex markets. All right, that's enough for me, guys. I hope you're all having a great start to your week, and I'll see you all in the next video. Stay tuned.